I think that sounds alright.
The 7 deadly sins of investing. Number 1, pride. Pride is deadly. Pride is thinking you know everything. It's going to stop you asking a silly question or asking for help. We humans are proud creatures, and we often don't like to ask for advice or admit when we are wrong. Pride is an excessive belief in one's own ability. In all markets there is no perfect information, meaning that nobody can predict what other humans choose to do. There are too many random events happening around the world that it's impossible for someone to know all the available information in each market. Think back to June 2016. If you had placed a £10 bet on the 3 events of Brexit, Trump getting elected to the US presidency, and Leicester City winning the English Premiership football title, you would have won £10 million, according to the Independent newspaper, a Nobel Prize in 1978. This means that basically we don't know what we don't know. Understanding that we can't know everything is a good step to understanding how to invest. This is why financial education is so important and can stop you from becoming overconfident. Pride often comes before a fall. By trying to take too many risks, or even worse, not understanding the risks, you are causing financial pain for yourself and your family. Money tip lesson 1. Education is key. Knowing both yourself and the principles of investing will help you reduce your risk. Deadly sin number 2 is envy. Today it's become normal to view other people's social media feeds, showing us their new possessions like cars, TVs or swimming pools, trying to impress other people they don't really like by buying stuff they don't really need. It's only after we realise that most of these influencers have bought their stuff on credit cards. Envy is the desire for other traits, status, abilities or situations. I've been guilty of envy myself. I missed the boom in London housing market. I was attempting to time the market and getting it spectacularly wrong. Average house prices in London have risen 518% since 1994, according to the Office of National Statistics. It's often hard not to feel envious of previous generations or other people who have bought their houses before them, people who take it for granted that having a home that is affordable. Most of these house price increase were due to demand and supply. I felt envious, especially at dinner parties, when the topic of conversation would turn to how much each person's house has risen on Rightmove since they bought it. It's important to follow your own path and understand there's an opportunity in every business cycle. Having a life plan, which is step 3 in the money mindset, will help you understand where you're heading for your future and help best reach your goals, so you can focus on how far you've come yourself and not focusing on others. Money tip lesson 2. Have a life plan and know where you want to get to in both your life and your finances. Deadly sin number 3 is sloth. Sloth is the avoidance of work and comes from not doing your research or taking the time to learn how to invest. Investing is a life skill and gets better by practice and learning from others, which is why being surrounded by other people who are on the same path as you will really help, and also being in investing accelerators will get to your goal quicker. It's much easier to buy on someone else's tip because they are buying it than understanding the fundamentals of investing. Investing is more about understanding yourself than understanding different companies or the market. What are your aims and objectives? What do you want from the market? Having good daily habits with money, putting in the work and setting up correct investment systems can save you more work in the long term. It's also the discipline to spend time learning how to invest and to spend less than you earn. Long-term wealth can never be built if you spend all your winnings rather than reinvesting it back into your business system. Money tip lesson 3. The hard road turns easy and the easy road turns hard. Putting in the work today will pay off tomorrow. Deadly sin number 4 is greed. Greed is the desire for material gains. Everyone is a little bit greedy. We're all human after all. Lifestyle is different for everyone. We can choose to have a big lifestyle or choose to have a small lifestyle. When we think about it, after health and family, lifestyle is all anyone wants in life. We need to understand our number, which means how much money we need to live on for the rest of our lives. If we want a big lifestyle, then we need a big number. And if we choose a small lifestyle, then we only need a small number. Once we understand this number, this helps us to accumulate it, manage it, protect it, and most of all spend it. This is proper financial planning. If we choose to spend more than what we earn rather than focusing on what is meaningful in life, then this is where we get greedy. Greed can often come from wanting these things quickly. Investing is a long-term process and patience is important. Greed can mean a lack of patience, increasing the amount of risk we take. Greed may mean you overstretch yourself. Greed is wanting to have the golden eggs before the golden goose has a chance to lay them, from the popular children's story. Money tip lesson 4. Patience and time is your friend in investing. Trying to rush the process is like trying to rush the egg out of the chicken. Anything of value takes time. So number 5. Deadly sin number 5 is gluttony. Gluttony is the desire to consume more than one requires. Investing is a long-term process, buying assets like businesses, property, and by lending money to others that will result in receiving an income being paid to you. Speculating is a short-term process, trying to buy or sell on the hope that someone else will want to pay more for it. Where it gets dangerous is buying things that you don't have on credit, or even worse, buying or betting on a leveraged position, often called buying on margin. This means you're taking a position of say £1,000 of exposure by only putting down £100 of your own money. This leads to gluttony, as it can lead to spending more money than you have. Buying on margin can leverage your winnings as you're using borrowed money. However, if that position goes against you, you have to not only pay back your losses, but also the losses that you have borrowed, often from a broker. Things can quickly spiral out of control, and you have to pay the borrowed money back with a huge buy back your previous positions. This leveraged or margin positions are what caused the 1930s crash, or was at least partially to blame for it. Money tip lesson number 5. If you don't have the money, don't bet or trade with someone else's money. Deadly sin number 6 is wrath. Wrath is extreme anger, and there is a danger with this deadly sin. Wrath is emotion, and emotions can be dangerous when investing. There is often a difference between getting emotional about what you can control and what you can't control. We all have an individual sphere of influence, and getting angry about what we can't control is futile. If you lose your job due to redundancy, or because your industry no longer has that demand, then there's no point fighting against the force of the flow, since there is no chance that you can affect the outcome. Once you understand that you can't control external forces, you can only control your reaction to it. Then you can choose how to react to the stimulus, like coming up with different solutions, or finding out different ways, different jobs, or different areas where you can add value to other people's lives. Having this choice is powerful. Money tip lesson 6 is knowing that there are opportunities in any market, and you can focus your energy discovering these opportunities. Deadly sin number 7 is lust. Everyone loves a story, as it appeals to the human part of our brain. There is a danger of falling in love with a story of an investment. This might be Steve Jobs coming back to Apple and saving the company, or the potential of blockchain technology and Bitcoin. It's easy to get swept up in the emotion, and we like to tell our friends about it. However, from an investing point of view, this can be dangerous. We humans have evolved to be wired to be terrible investors. We often buy when we should be selling, or when it shows no long-term value, or that everyone else has bought the same story and it's pushed the price of the shares up. Like always falling in love with the wrong person, this can have negative effects on us. Being unemotional and unattached to our investments is important, although it's much easier said than done. Putting money into investment funds where your money is pooled with other investors is a good way to stop yourself falling in love with one share, and more importantly, reducing company risk too. Money tip lesson 7: investing in investment funds to stop yourself falling in love with a company, as well as reducing company risk. This is buying not one share, but buying either tracker funds which track the market, or investment fund which pool a number of different companies together to reduce the risk of companies. Which of these deadly sins have you been guilty of?
Money mindset. I think that sounds